A structural warning just hit global markets, and almost nobody sees it, because everyone is still focused on the Federal Reserve's December 10th rate cut. But three major signals just arrived at the same time. And together, they're telling us something the market does not want to hear. Rate constraints are returning much faster than anyone expected. The turning point began in Europe. ECB board member Isabel Schnabel said she's comfortable with the next move in rates being higher, not lower. That single line rewired the entire European curve. Cuts vanished. Yields on German 5-year bonds jumped nearly 10 basis points. Longer-dated bonds hit their highest levels since 2011. And for the first time, traders assigned a 1 in 3 chance of an ECB hike by 2026. Europe's easing cycle might already be over. But the real shock came from Canada. The Bank of Canada wasn't expected to do much. Some even expected more cuts next year. Then Canada released a labor report that flipped everything. Unemployment fell. Job gains surged. Yields exploded. And now traders are fully pricing a Bank of Canada hike by October 2026. Not a cut, a hike, off the back of one of the strongest labor rebounds of the year. Put these together, and the message is unmistakable. Both the ECB and the Bank of Canada have hit their rate floors. Their next move, whether in 6 months or 18, may actually be upward, not downward. Not easier policy, not the soft landing glide path the market is betting on, upward. And this is where the United States enters the picture. Because even before the Fed meets on December 10th, bond traders are quietly shifting. A week ago, markets were pricing 3 Fed cuts next year. Now they expect barely half a percentage point of easing in 2026. Some desks are hedging against a scenario where the Fed stops cutting by mid-year and then pauses. And a growing number of strategists are warning that a Fed hike in 2026 is a real risk if inflation proves sticky. This is happening even as the labor market shows mixed signals. Job openings surprised to the upside, but layoffs rose to the highest level since early 2023. Hiring fell sharply, and the quits rate, the strongest indicator of worker confidence, dropped to its lowest reading since May 2020. Beneath the surface, the U.S. labor market is cooling. And that cooling is one of the main reasons investors feel confident the Fed will cut. But now we know something more important. Powell didn't just cut rates, he forced the cut through a divided Federal Reserve. 6 policymakers quietly signaled they wanted no cut at all by projecting the same rate for 2025 that existed before the decision. Only 4 of the 12 regional banks recommended easing. Former officials are openly saying the cut was a mistake. And this deep internal split is something the Fed hasn't seen in over a decade. The Fed is no longer unified behind easing, which makes future cuts far less certain than markets assume. So when you put all of this together, the global picture becomes clear. Europe is signaling higher rates. Canada is pricing higher rates. US bond traders are preparing for a much shorter cutting cycle. And inside the Fed itself, dissent is rising against Powell's push to ease. This is not the world the market thinks it's in. The market believes inflation is on a one-way path lower. But the ECB, the Bank of Canada, and the US rates market are all signaling the opposite. That structural pressures, fiscal deficits, and wage dynamics are not easing fast enough. If they're right, global rate floors are rising again. That means the window for Fed cuts is far smaller than investors think. And the path back to tighter policy could come much sooner than anyone is pricing. The Fed cut on December 10th, but that cut might not be the start of an easing cycle. It might be the last clean cut they get before global inflation constraints snap back. And if that happens, markets are not prepared for what comes next. This is Macro Pulse, Global Notes by JP. If you found this helpful, comment, like, share, and hit the bell. We're building the strongest macro community on the platform, one signal at a time, together.